So what we're looking at is a comparison so you can kind of see where we think, and the researchers at City National Rockdale believe things are going to shape up from a GDP and inflation standpoint. GDP growth, the top line there, in 2023 was 2.5%. That's fairly standard growth for a mature economy like the United States or Central Europe. We're forecasting a slowdown. We're forecasting in 2024 that to slow down to be about 1.75 to 2.25%. And then when you look out into 2025, we're also expecting it to moderate, be about the same. So we're looking at 2 years possibly of slower growth. However, when you look at corporate profit growth, okay, companies that have been able to cut back, stay lean as far as their expenses and manage through a slower economy, their profit growth was only 1% in 2023. However, this year we're expecting that to fall somewhere between 9 and 12%. And next year, somewhere between 8 and 12% in profit growth on average for corporations in the United States. That's one of the reasons we're seeing the stock market stay elevated and continue to grow, because the next couple of years look like those companies are going to return to making money. Headline CPI for the year end in 2023 was 3.3%. Which is significantly down from the high that happened in June of 2022, which hit over 9% inflation rate. We're seeing that in 2024 and 2025 to moderate and be more historically in line with the average, somewhere between 2.75 and 3.5%. Right now, I think we've been averaging in that 3.3 range this year. The Fed is hoping to slow that down a little bit more. That's why they're keeping interest rates elevated. And the good news, though, is we continue to see that slight slowing of inflation in 2025. So that's the plan moving forward. That's all a positive for the market. The core CPI is just another way of measuring inflation, and you can see that also is moderating. When we look at the federal funds rate, right now we're sitting at 5.25 to 5.5%. We expect a rate cut to take place, maybe 1 or 2 this year towards the end of the year, and get that rate somewhere down around 5 or just under 5%. Significant improvement we're expecting next year with maybe 3 rate cuts in 2025 and getting that down a full point to 1.5. Treasury notes. Good news is for those fixed income investors, we're forecasting seeing an uptick in those Treasury note yields to get over 4% this year and maintain that into next year.
It's interesting when you're talking about where the Fed rates are going. For those, and this is really going to be interesting with the housing market. Because if the rates get down to that 4% rate, that's still historically a low rate for mortgage.
Yep.
You get down to that, then you'll see some movement in the housing market. So anybody who can really kind of hold off making their moves, a little bit of patience over the next year and a half can save you a lot of money in interest relative to the mortgage. Plus, give you a lot more options relative to where you can move, where you want to move, and the housing as a whole.